In this video, I'll be breaking down how much you need to make in order to afford a 2023 Toyota Sequoia. There are 4 options I'll be covering today, and you can decide on which one suits you best depending how into cars you are. Some people just want a reliable form of transportation, and some are willing to spend quite a bit more to really get the car that they want. Stick around to the end of the video to find out which method would be best for your situation. This is 4-Wheel Finance, a channel dedicated to helping you making smart financial decisions. Before I dive into the first rule, these videos take a lot of time and effort to make, so please click the like and subscribe button and comment down below what other vehicles you would like to see. The first rule is the 24-10 rule. This states that you must put at least 20% down on the vehicle, you can't finance it for more than 4 years or 48 months, and the payment can't be more than 10% of your monthly gross income. Given that the 2023 Toyota Sequoia has an MSRP of $58,300 to start for the base model, you would need to put down $11,660. And with the average new vehicle interest rate of 3.86% and a 48-month term, this would bring your monthly payment to $1,050.17. Note that you're also paying $3,768 here in interest. Bankrate states that the average monthly insurance cost is $148, but to be more accurate, use the Smart Financial link in the description below to find out exactly how much it would cost for you to insure a 2023 Toyota Sequoia. This brings your monthly total to $1,198.17, not including gas. Back to that 24-10 rule, given your monthly cost would be $1,198, you would need a monthly gross income of $11,981.70, or an annual gross income of $143,780.40. I really encourage you to look at the opportunity cost here. If you were to buy a cheaper $10,000 car and put what would be your car payment of $1,050.17 in the market instead, over the course of 5 years and a conservative 6% return rate, that would turn into $73,327.08, gaining over $10,000 in interest alone. And this is just for the first 5 years. If you were to continue that for 10 years, it would amount to $171,455.26 at only a 6% rate of return. For reference, the stock market averages around 10% return per year, so this is pretty conservative. The next rule is the Dave Ramsey rule. You must have a 3 to 6 month emergency fund built up, the vehicle can't be more than 50% of your gross annual income, and you must purchase it in cash. Given that the 2023 Toyota Sequoia starts at $58,300, your annual gross income would need to be a minimum of $116,600. If you were to purchase this vehicle in cash, you would avoid having to pay that $3,768 in interest that you previously saw, and your insurance costs would be a little bit lower as well. But obviously, not too many people have $60,000 in cash that they can throw at a car. Those first 2 rules are pretty difficult to achieve. You would assume the average person wouldn't be able to follow those goals, which is why I've come up with my own. For my rule, you need to have at least a 6-month emergency fund, you need to invest 15% of your gross income into your 401k, and need to max out both your Roth IRA and your HSA. Yes, I know this must seem like a lot of saving, but there isn't a monthly percentage rule you have to stick to, so it's really up to you to decide if you want to spend more of your monthly income on a vehicle, or if you'd rather go out to eat more and vacations, etc. And that 6-month emergency fund is just there to ensure that you're covered in the case of, obviously, an emergency. And the investment portion gives you some financial security later in life when you're probably going to need it the most. The majority of people say, well, nothing's really guaranteed, and while that's true, it's difficult to put a value on having peace of mind for yourself or your family. The last rule is the 1/10 rule, which was developed by Financial Samurai, and personally one that I think the majority of people trying to build their wealth rapidly should follow. It really doesn't allow you to buy a new vehicle, but it does allow you to spend responsibly, which reduces your financial stress and increases your net worth a lot quicker than other methods over time. It's pretty straightforward. It states that you shouldn't spend more than 10% of your gross annual income on a vehicle. You must own it for at least 5 years, and the theory behind this is to minimize your financial stress, and this frees up some other money to invest in assets or opportunities that may come your way. As I mentioned earlier, you can see how much investing can go over 5 or 10 years. I mean, imagine if you were to spread that out over 30 or 40 years. That'd be a heck of a lot more returns. It's much more stressful and difficult making life decisions when you're worried about payments each and every month. Once again, this is 4World Finance. If you have any questions regarding car buying or how much you can afford, please leave them in the description below, as well as any other vehicles that you would like to see.